Hello everyone, this is Megha Bhandari and I'm delighted to welcome you all to this insightful session with Mr. Arun Sundaresan. Today, we will be diving into two exciting NFOs, the Nippon India BSE Sensex Next 30 ETF and the Nippon India BSE Sensex Next 30 Index Fund. Mr. Sundaresan will be sharing his valuable insights on these NFOs. So let's get started and hear it straight from him. So welcome Arun. So let's start with the bigger picture. What is the core investment objective of these funds and what gap do these funds fill in an investor's portfolio?
So our investors would be familiar with Sensex, right? These are the top 30 stocks listed on the Bombay Stock Exchange. Top 30 stocks by way of free float market cap. In other words, the size of the company. So these are the 30 largest companies in India. So these funds will invest into the next 30 stocks, that is stock number 31 to 60. Essentially, they are large cap. So what investors get is an exposure to the large cap part of the market. But because it's investing into the 31st to 60 stocks and the weightages could be different when compared to most of the other indices, you get a very different portfolio.
So Arun, there are so many large cap indices like the BSE Sensex, the Nifty 50, the Nifty 100, the Nifty Next 50, etc. So, how is this fund differently positioned?
So, as we just spoke, this is going to invest in the 31st to the 60 stocks in the Bombay Stock Exchange.
Right.
Therefore, it has no overlap with BSE Sensex at all. The BSE Sensex stocks are not considered at all. But even with other large cap indices, like you mentioned Nifty 50, the Next 50 or the Nifty 100, this one has a very limited overlap. For example, with Nifty 50, the overlap in terms of, I'm not talking about the number of stocks, the weightages of those stocks, the overlap is only 14% with Nifty 50. With Nifty 100, it is 18%, and with Next 50, it is 32%. So essentially what it means is that by investing into this portfolio, when compared to the other large cap indices, you're going to get a very different exposure. The overlaps are very less, as I pointed out.
So if the composition is the same, whether it's an index or an ETF, then how do investors make a choice?
So ETF, exchange traded fund, and index funds are two different formats through which investors can invest into these funds, or for that matter any funds which come in different formats. But both operate very differently. ETF is listed on the stock exchanges. It offers several advantages. One of the main advantage is that investors will be able to transact during the day. Suppose you want to buy it at 11 o'clock or sell at 12 o'clock, those things are possible in the ETF format. Of course, you need to have a demat account to do that. Index fund, on the other hand, like open-ended mutual fund schemes, you'll be able to transact only based on the day-end net asset value, the day-end NAV. So this is the main difference. Otherwise, in index funds, you can make systematic investment plans. And if your objective is to invest and stay put for the very long term, you can also choose the index format. ETF, on the other hand, you need to have demat, and if you want to take advantage of the intraday movement, if you want to transact anytime during the day, you can do that. Otherwise, both are good options for you to make investments into.
So how does this portfolio fit into investors' core versus the satellite portfolio framework?
So these funds actually offer large cap exposure, being part of BSE 100 and investing between the 31st to 60 stocks. What you get is large cap exposure. The portfolio also would be diversified across sectors, multiple sectors. Therefore, investors, depending on their risk appetite, could consider this for their core allocations.
So how has the BSE Sensex Next 30 index performed in the past?
The index data is available from 2014. So 2014 till now, if you look at all the data and if you looked at the 3-year rolling return. So what we mean by 3-year rolling return is a 3-year return on an average for this particular period. So that number is working out to be 14.5% CAGR, the compounded return.
Thank you so much, Arun. It was an extremely insightful session. NFO closes 4th June 2025. For more information, log on to the details shared below. Till then, stay happy, stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.